Okay, so you're probably watching this wondering what the opening range breakout strategy is, and at the bottom you can see how do you turn profitable with this strategy. So there are multiple things that have to go into the opening range breakout that I'm going to cover in this video that'll help you turn profitable with your trading when it comes to using this strategy. One of the first things that you need to do in the daily basis when you go and you log into whatever prop firm, chart, or brokerage that you use, if you're doing the opening range breakout strategy, is to mark out the highs and the lows from the 15-minute open. Okay, so if you're trading London, 9:30 New York time, you'll mark out in the low of the first 15 minutes of the candle. So as you see on here, the opening range OR is the first 15 minutes of the session. This is defined by the opening range high and the opening range low. In the next slide, I will show you a picture of what that looks like. This range sets the tone for the trend, volatility and liquidity grabs. Okay, so this kind of starts the tone for how the trading is going to look for the entire day. Market often also establishes a key directional bias here. So if you're seeing price push up super hard in the beginning, right, and it breaks out of your opening range, there's a good chance that that's what the price is going to do for the day, right? Might come back down, retest, and then shoot up. But this is part of what it does on a daily basis. Okay. Here's an example of marking the highs and the lows. So if you look here on the chart, you can see 9:30 open. This is the high and the low. Remember, you must mark out the wick as well as the body. Okay. So you don't want to just go right here with the body. You want to go to the wicks of the candle. Okay. So that's how you mark that out. And remember, 15-minute time frame. This is MNQ. Works as well on gold and other futures as well. Why does this range matter? Okay, this range provides clear structure for breakouts and reversal setups. It helps filter noise from the 1 to 5 minutes of volatility that the market starts with. The first 15 minutes of the market can be crazy. Okay, this was a really good example of a pretty good first 15-minute candle. There's times where it will wick all the way up and have a super small body. Okay, the first 1 to 5 minutes of volatility are crazy in the market, and you want to stay away from that and wait a little bit to enter trades until it breaks out of that range. It creates a reliable framework for direction-based trading as well. Some breakout conditions. So in order to have a bullish bias, you want price to close above the opening range high. Okay. So if you want a bullish bias, the price must break out from here. If you want a bearish bias, right, you want to break out below that range. Okay. Avoid wick only breaks. Prefer candle body breaks. Okay, so I have examples of this in here in a little bit, but you do not want to take a breakout trade to the top side if it's just a wick coming out, right? Because that does not show strong buying power. You need it to be a body that is breaking out of the top of the breakout range to indicate that, okay, we have a strong move up. Or in a different, if you're doing bearish, right, you need a strong break to the bottom of the breaking or the opening range, and you need to break out strong, because if it's wicking down, there's a good chance price shoots right back into the range. After you have these conditions, right, you're going to move down to either the 5, 3, or 1 minute time frame on the chart. Personally, I do the 5 because while doing the 1 and 3, you're way more likely to get faked out because you are not in a certain price range for a long time. Okay, so I dropped to the 5 minute. I identify displacement candles that show strength, right, either bearish or bullish. I look for a newly formed fair value gap in the direction of the breakout. This is optional. Most people, when they're trading opening range breakouts, do not use fair value gaps. I personally do. I find more success in them. Okay. If you don't know what a fair value gap is, leave a comment below. I can teach you what those are as well. Fair value gaps should form outside the opening range or inside, but after the displacement. So they should form on the outside, right? Price breaks out, pulls back to a fair value gap outside the range, and then continues up or continues down, or it breaks out after the displacement, comes back in to the opening range, hits a fair value gap, continues higher. Here's a bullish break example. Okay, so you see here's your opening range. Okay, now so 5 minute, 5 minute, 5 minute. There's 15 minutes of candles right here. I switched to the 5 minute. Bullish breakout, right? Not a huge wick, strong body, consolidates a little bit up here, immediate pullback into this fair value gap. Okay, that's a perfect example. What happens next? Price breaks out of the fair value gap, still in the 5-minute. You enter at this candle with your stop below the fair value gap, right up and out again. Okay, and price actually continued up even higher. Okay, here is retest entry criteria for bullish example. Okay, you want price to break above the high, bang, displacement, 5-minute fair value gap forms, wait for price to retrace into the fair value gap, which it did here, enter long as it does that, bang, and you're out. Stop loss below the fair value gap. Target I do 2 risk to reward ratio. A lot of the time in this scenario, you'll get to around 2 to 3. It'll kind of consolidate and either rip back down or it'll continue up to 4 or 5R. So I stick with 2 just to be more confident in my trades. You also can target some session high liquidity that's above, right? An example right here. You could target right above this wick here. Here's a bearish example, right? Price breaks below the opening range right here, strong, super strong, break below, okay? Price comes back in, tests this fair value gap that is created in here. As soon as it tests in here, after the 5-minute fair value gap, rip right back down. And you're putting your stop right above the fair value gap. So this is a pretty tight trade. Although it's tight, it is very possible to get to RR. I actually thought this was a 3 RR on this trade, okay? The best market conditions for trading this in general is high volume sessions like New York and sometimes London. I wouldn't recommend doing Asia session, even if you're doing gold. Trending or strongly directional days, okay, you don't want price action doing a whole bunch of this because that will get you nowhere with the breakout strategy. Odds are it'll come back in and reverse on you. You want clean or structure without excessive chop, like I just mentioned. Some of the instruments that trade the best with this are M&Q, right? NQ, ES, gold, major FX, also just gold that's not micro, just regular gold, and then some cryptocurrencies as well off opens. Some final notes that I would have for you for trading the opening range breakout strategy would be patience is key. Wait for the retest. Okay, if you're trading original breakout, right, you're not waiting for the retest, you're entering as soon as it breaks out of that range. But if you're doing the retest as I would do it, you need to be patient. There's going to be days where you're watching prices rip up or down out of the range and you're like, shit, should I have got in? Like I really should have just really got in right there. But you need to wait and be patient. Avoid chasing breakouts. You cannot just chase as soon as you see the price going up. Odds are you might catch it once or twice. You might start feeling confident. The next time you catch it, it's going to rip right back down or right back up as soon as you enter. You're going to take huge losses and wipe out what you would have just made the last time you traded it. The strategy combines structure, volume, and liquidity. So there's a lot of things that go into the trading strategy, as well as, right, you're using fair value gaps. You can use Fibonacci levels on this. I can teach that as well if we need to learn how to use Fibonacci levels. You can use standard deviation as another great one for you to use, okay? Volume changes, amazing to use for it. And it works best with consistent journaling and review. I consistently journal as well as use a Google Sheet to track my trades. If anybody wants access to seeing how that works, I would love to share it. But if you seriously have any questions, please let me know. I'd be glad to help you. I think that's the end of the slides. For my next video, it will probably be me testing the market from today to see if my strategy would have worked. I'll post that. And then starting on Monday, the following week in December, I will start trading the eval for you guys and uploading my daily trades from the eval. So if you do have any questions, feel free to let me know. I'd be glad to help. If this video helps you, leave a like, leave a comment. And if you need anything else, please let me know in the comment section below. Have a good rest of your day.